The NASDAQ is higher again this morning, up more than 10% for the year and on pace for its seventh consecutive positive year for the first time since its inception in 1971. But Facebook and Netflix have both had weak quarters that sparked significant sell-offs. RBC Capital warning that tech's run is coming to an end. Joining us now, the author of that report, RBC Capital Markets head of U.S. equity strategy, Lori Calvasina, and Foundation Capital partner and longtime tech investor, Paul Holland. Welcome to both of you. Lori, you are a bear on tech in a time when Apple has hit $1 trillion market cap. Fair to say, I guess you've been wrong, at least on big tech so far this year, but you feel like things are turning your way. Why?
So we actually went underweight the sector back in April. So we think our call was a little bit early, but we don't think that we're wrong.
Okay.
And we're very regimented in terms of sticking to our process. We have different drivers we look at for sectors, and what we're starting to see are problems emerging, extremes, and also some signs of deceleration. So earnings have been fantastic. We're actually noticing that there's a deceleration in the rate of upward revisions. There's also a deceleration in the rate of sales beats. And that's important because that's one of the big reasons why people have been dumping into this space for the last, frankly, 6-7 years, was the superior earnings growth story. That seems like it's starting to fade.
FANG stumble kind of adds to your argument.
Yep.
In terms of where you think valuations are less reasonable, more reasonable, you think services is where they're truly expensive?
Yeah, so we've actually found if you look at a PE multiple or EV to EBITDA, you basically hit post-tech bubble valuations at the midpoint of this year, and we're starting to retreat from that a little bit. But when we dig down and look industry by industry, the two that really jump out as the problems are actually IT services. There's a lot of fintech stocks hiding in that group, but also the software space. We think internet had a crowding problem. It had a deceleration in earnings momentum that was also a problem coming into this reporting season. But your big valuation problem actually isn't sitting in those internet stocks.
Paul, is it too early to call a top here?
I think it's too early to call a top, and particularly when you look at the different stocks that are out there. What we tend to see, and in our own portfolio, we see sort of a barbelling, and we see a barbelling of what we see across happening in the Silicon Valley. If you look at Foundation's portfolio, companies like Chegg and Sunrun and others are growing at a very robust pace. They're being rewarded for it in the marketplace. If you look at other companies in the Valley and other public stocks, Lori's correct in the sense we're in a 7-year run here, and some of those guys are going to start to get a little bit tired. The pace is pretty brutal, and folks have got to be able to keep up and keep innovating and keep the growth rates up.
When you say that with some of these bigger tech names that maybe the pace is starting to slow down a little bit, are you referring to Netflix, which has been the other underperformer over the past month? I know you're an investor there.
Yes, so we invested in Netflix back in 1999, and obviously have been big fans of the company ever since. I don't tend to watch companies kind of week to week, month to month in terms of public stocks. We're early stage investors. When we invested in Netflix, there were probably 30 people in the company. And so I don't know, in terms of the different aspects of the most current reporting and so forth. However, when I look at a company like a Netflix, I look at a company like a Chegg, a Sunrun, and others that are out there, they're disrupting trillion-dollar industries with incumbents that are growing at 1 or 2% a year. So whether or not those companies have a stumble along the way, they're still moving up and to the right, and we still see a ton of upside in those type of companies.
So, Lori, when you're looking at the areas in tech that are safest, hardware and equipment, you say, just from a valuation perspective, look best. But, I mean, growth-wise, are they really that safe? I mean, if we get a downturn in the market, you think investors are going to rush there or at least stay there?
Well, what we see on the tech hardware and equipment space in particular is it looks a little bit less crowded than some of these other areas. We see that when we work through some of our work on individual names. And the earnings momentum is actually positive. It's actually the strongest group on our earnings momentum indicator. So we think you've got a little bit of a safety angle from that perspective as well. But flat out, the valuations just look a whole lot better. And I think, we have to sort of ask, why do valuations matter? Because they didn't matter for a long time and now they're starting to. What I think it comes down to is when you have these extreme valuations in other areas, they are priced for perfection. And when perfection doesn't come through, these areas are getting punished very, very mightily, and you just don't have that same risk in this hardware and equipment space.
Hey, Paul, for a long time, it was hard to separate the narrative of tech's long-term growth from China. And I wonder if you game out a less than optimal outcome with these trade talks, I mean, how much is at stake if the possibility of China growth over 10, 20 years is sort of maybe, if not taken off the table, cut significantly?
Yeah, I have to believe that over a longer period of time, these tariff conversations and the trade issues are going to get settled in some form or another. So in the near term, I think it's very turbulent. I think it's frustrating for those of us in the Silicon Valley. We run a massive trade surplus all over the world, but we also invite people from all over the world who are really smart to come here and start companies. And that model seems to work really, really well. The notion of going around and selectively trying to disadvantage one company or one industry from another in a tariff situation is unpalatable generally. But if I look at that and I look at what's going on here, and if I move over to what we're seeing in the early stage here, we're seeing a tremendous amount of excitement. If you look at the AI and ML space, there's a tremendous amount of innovation now really happening up and down the software stack with companies like Cerebras and Maya and Response Software. If we're looking at consumer marketplaces, we see a lot of activity and growth there. We're in a company called Rover in the dog space, Peerspace and others. So we still see a tremendous amount of innovation here. And I think what we tend to see happening, I think Lori's doing a good job of capturing this, is occasionally what we see is we see this terrific kind of long-term path toward innovation and growth. And then you're going to see temporary perturbations in that in some of these public stocks as they perhaps get out ahead of themselves a bit.